reAlpha Tech Corp, ticker AIRE, is currently trading at $0.73, showing a massive intraday spike of 61.37%. Now, before anyone rushes to their Robinhood stock trading app or Fidelity mobile app thinking they've just stumbled upon the next NVIDIA stock at a bargain price, we need to have a serious conversation about what this 61.37% jump actually signifies. The immediate reaction, the expectation, is that the company must have just announced something transformative. Perhaps that its artificial intelligence platform has finally cracked the code on real estate, or that a major institution is buying in. The reality, however, is almost certainly more complicated and, frankly, far riskier. When a stock trading well below $1 makes a move of this magnitude, the driving force is often mechanics rather than fundamentals. We are likely looking at a classic low-float, high-speculation event, and getting caught on the wrong side of it can be devastating for an individual brokerage account. Let's establish the common ground, because the narrative around reAlpha is undeniably compelling. The market is saturated with investors looking for the next big intersection of technology and tangible assets. The belief is that reAlpha is building a sophisticated system to use AI to identify, acquire, and manage short-term rental properties. Think Airbnbs at scale, effectively trying to democratize real estate investment for the masses. It sounds fantastic on paper. You see AI in the name, you see the real estate angle, and you automatically think this is the ground floor of something big. It's the kind of story that gets traction on investing sites and forums. People look at their online investment portfolio and think this is the high-growth component they've been missing. Maybe even a specialized intelligent portfolio for a single high-growth sector. But here is the fundamental disconnect we have to address. Today's 61% move does not confirm that business model is working. It only confirms that a cluster of traders, and perhaps algorithms, have piled into a very thinly traded, speculative name. This is not the slow, steady, institutional accumulation you see when Fidelity mutual funds or Fidelity wealth management divisions decide to build a long-term position in something like Apple stock. This is the financial equivalent of a flash mob. This is rapid-fire activity likely driven by technical scanners looking for momentum and retail traders hoping to catch a rocket. We must forcefully separate the business of reAlpha from the stock of AIRE, because at this moment they are telling two very different stories. The business is a long-term venture endeavor. The stock, today, is a volatile trading vehicle. Let's break down this 61.37% surge because the details matter. The first question any serious analyst asks is, on what volume? Is this 61% jump happening on 20 million shares traded or 500,000? If the volume is thin, as is common with many nano-cap stocks, this entire spike could be a mirage. It could evaporate by the closing bell. Many professional traders using sophisticated platforms like Interactive Brokers, which is known for its advanced order execution and data, might just be playing the spread. They aren't holding this for the long term. They are scalping the volatility. This kind of price action is a day trader's paradise and a long-term investor's nightmare. A stock trading at 0.73 is in a deeply precarious position. It is far into nano-cap territory, which means it is extraordinarily susceptible to news, rumors, or even some large market orders. We are not talking about the kind of liquidity you find in Tesla stock, where tens of billions of dollars can change hands in a single session without causing this kind of percentage swing. We are talking about a stock where a single $50,000 buy order, placed incorrectly as a market order, could potentially move the needle in a very visible way. This creates an illusion of strength that isn't backed by broad market participation. This is a critical concept for anyone doing self-investing to understand. The price you see on your SoFi trading platform might not be the price you can actually get, an issue known as slippage. By the time you see the 61% jump and place your buy order, you might be the person buying the absolute top from a trader who got in 30 minutes ago. Now let's place this in the macro context. The real estate sector itself is under immense sustained pressure. We are in a high interest rate environment. This makes the cost of acquiring properties, which is central to reAlpha's presumed business model, enormous. If their AI-driven acquisitions cost too much due to high financing rates, the entire model risks breaking. The math simply might not work. Furthermore, the investment climate for speculative technology companies, especially those that are not yet profitable, is incredibly shaky. Investors are no longer handing out capital for growth stories alone. They are demanding a clear path to profitability. While platforms like SoFi Invest make online investing incredibly accessible, they also make it frictionless to get caught in these high-velocity volatility traps. What are the institutions doing? Are major Fidelity investments or Fidelity brokerage accounts filing 13Gs to disclose large new positions? It is highly unlikely at this price point. More likely, we are seeing a surge in retail activity, perhaps coordinated in online forums, or purely algorithmic trading hitting on technical signals. Professional investment help and institutional portfolio managers, the kind who build Fidelity IRAs designed for long-term security, typically steer clear of sub-$1 unless it's a very specific controlled venture capital play. They are not building retirement portfolios on the back of 60% intraday pops in nano-caps. We also must consider the possibility of a short squeeze. Given the stock's likely prolonged decline to reach this 0.73 level, it's plausible that some short sellers are being forced to cover. But squeezes on nano-caps are notoriously unpredictable. They can reverse in a matter of minutes, leaving self-investing individuals who bought at the top holding a significant bag. We also must look at the recent SEC filings. Has there been an 8K announcing a new contract? Or, more cynically, is a new S1 or S3 registration pending? Often, a spike like this follows the announcement of new financing, which can be massively dilutive to existing shareholders. Or perhaps a reverse stock split announcement is pending, which the company might need to do to regain compliance with the exchange's $1 minimum bid price rule. Traders might be trying to front-run this. The expectation is always good news. The reality is often necessary financial maneuvering that doesn't benefit the common shareholder. So what does reAlpha Tech Corp actually claim to do? The company's stated goal is to build and operate a platform that uses AI to identify, acquire, and manage a portfolio of short-term rental properties. The idea is to optimize occupancy, pricing, and returns, theoretically better than a human manager could. They have also focused on a tokenization aspect, suggesting a future where investors could buy fractional ownership of these properties, which is an interesting concept for investing sites that taps into the same psychological desire for new, disruptive assets that fuels Robinhood crypto trading. The platform is meant to be its own intelligent portfolio for real estate assets. However, the company's performance history is brief and extremely challenging. Since its initial public offering, the stock has seen a significant and painful decline from its initial highs. This is a very common trajectory for many small-cap companies, especially those that may have gone public via SPAC, that hit the market with enormous promises but run headfirst into the hard, cold reality of operations costs, competition, and capital requirements. They are operating in a space that is not only capital-intensive, but also brutally competitive and fragmented by local regulations. This brings us squarely to the future outlook, and this is where we must be incredibly disciplined in separating expectation from reality. The expectation. The 61% spike we see today is the absolute bottom. It's the start of a massive recovery. The AI is finally working, acquisitions are scaling up, and this 0.73 stock is on its way to 5, 10, or more. Early investors who get in via their Robinhood app or SoFi investing account will be rewarded for their foresight. The reality, however, is that reAlpha Tech Corp faces enormous structural headwinds. First and most immediate is the risk of being delisted from the NASDAQ exchange if it cannot regain and maintain a $1 minimum bid price for a sustained period. This situation often forces a company into a reverse stock split, which consolidates shares but rarely benefits existing shareholders in the long run. It's often seen as a sign of financial distress. Second, capital. This is the big one. Does the company have the cash on its balance sheet to actually buy the properties its AI identifies? If not, how does it get that cash in a high-rate environment without crushing shareholders through dilutive offerings? Third, competition. The short-term rental market is brutal. This isn't just about competing with other tech platforms, it's about competing with every local property manager and every individual host. So what are the possible scenarios? Scenario A, the bull case. This 61%